Welcome to the Gamma Brief. It is Monday, August 10th, 6:45 a.m. Eastern. If you're new here, the Gamma Brief is an experiment. The brief is built using a layered generative AI pipeline to capture market data, economic events, and structural mechanics, and then turn all of that into actionable briefings every morning. The brief is built on a single dataset, the SPX 0 DTE options chain. All the gamma levels, dealer positioning data, put and call walls, and the GEX flip point are calculated from that chain only. A reminder, Gamma Brief is market intelligence, not financial advice. If you find this brief helpful and you want to see more content like it, hit that like button and subscribe. If you want to see something new or have any feedback, something doesn't look right, numbers are off, leave a comment. All right, let's get started. ES futures are trading at 7,789. We spent Friday proving the floor at 7,650, but overnight action has completely bypassed the expected resistance. If this gap holds the open, dealer hedging inverts. If it fades, we test the structural anchors below. This is day 6 of a positive gamma regime backed by $6.5 billion in net dealer exposure. Under normal conditions, this means range-bound, mean reverting price action as dealers sell rallies and buy dips. However, there is a divergence this morning. VIX is rising notably overnight despite muted futures, indicating that hedging demand is increasing beneath the surface. We are operating 57 points above the 7,700 gamma flip, which keeps the broader regime intact, but the intraday mechanics are being tested. The geometry has been entirely upended overnight. ES sits 59 points above the 7,730 put wall and minus 14 from the 7,775 call wall. That's not a typo. ES futures at 7,789 have already breached dealer gamma resistance at the call wall and cleared R1 at 7,774. The first active resistance is now R2 at 7,790, just 1 point above current trading. The expected move band spans from 7,682 to 7,833. If the gap holds, the buffer is 59 points to structural support. If it fades, that buffer shrinks to 228. Friday's session was driven by a weak payrolls print that paradoxically supported risk assets on rate cut bets. That momentum carried into Sunday night. First, a tech-led equity rally pushed futures higher without a discrete macro catalyst. Second, cross-asset flows provided a tailwind, with the 10-year yield dropping 4 basis points and the dollar softening. Finally, we are seeing significant rotational behavior, with industrials up 2.6% while technology lagged, pointing to broad capital reallocation. The calendar risk score is a 1 out of 5 today. There is no high-impact macroeconomic events scheduled between now and the opening bell. Because the calendar is clear, the pre-market structure read carries directly into the session without the threat of a scheduled data drop forcing sudden dealer re-hedging. The weak risk score is 5 out of 5. Monday's light calendar is the exception, not the pattern. Wednesday at 12:30 p.m. Eastern is the event horizon. July CPI multiple components print simultaneously. Market is priced for cuts. That pricing is either confirmed or unwound in a single release. If the print is soft or in line, the positive gamma structure holds and may strengthen. If it surprises hot, rate expectations re-anchor, the soft landing trade compresses, and positive gamma is not guaranteed to contain the move. No fly zone Wednesday 12 to 1:30 p.m. Eastern. Thursday compounds the risk with PPI, initial jobless claims, and live Fed speakers, Hammock at 12:15 and Barkin at 12:40, all landing inside a 25-minute window. Friday closes with retail sales in Michigan consumer sentiment. The 7,700 put wall is this week's structural line in the sand. A daily close below it invalidates the post-payrolls thesis and signals a shift to defensive posture. Tuesday closed as the last reasonable window to establish pre-CPI structures at full size. The environment is consistent with defined risk directional setups if the breakout holds. Trend following in this tape is swinging for the fences inside a padded room, as positive gamma still exerts drag unless the structural break is confirmed. Defined risk directional plays are the appropriate alternative when the regime is testing its limits. A reclaim below 7,775 invalidates the upside read and pulls price back toward 7,730 equilibrium. The overnight gap has compressed dealer resistance before the bell even rings. This session will be defined entirely by whether the 7,775 call wall converts to support or acts as a trapdoor. 6 days, one regime. The longer it holds, the harder it breaks. Level set, bias defined. Good luck out there. Standard disclaimer remains. Gamma Brief and Gex Log are market intelligence, not financial advice. Options are high risk. Manage your size and trade your own plan.